Hello, I'm Malcolm Skinner and I'm a solicitor in the LexisNexis PSL private client team. Today I'm joined by Richard Wadsworth, the financial planner with Carbon Financial Partners Limited. Richard will be talking to me about the inheritance tax implications of spousal bypass trusts. Richard, in relation to pension funds in particular, what is the so-called spousal bypass trust, and indeed are they still relevant?
Yep, spousal bypass trust, it's a horrible sounding phrase, sounds like some painful medical treatment, but it's simply a mechanism to minimise inheritance tax. And despite all the changes in the pension death benefit rules of the last year or so, I still think that spousal bypass trusts have a relevance, albeit we perhaps have to think a bit harder about their application, and certainly we need to think about spousal bypass trusts on a case-by-case basis, and it needs to be kept under review.
Okay, so what are the pension rules regarding death?
There's now effectively 4 homes to which a pension fund can be passed on the death of a pension holder. One is outright as a lump sum to an individual. One is to a special type of pension of the individual. The third is to charity, and the fourth is to a spousal bypass trust. Now, for most wealthier clients, the option to pay the money to a charity is probably not the most efficient way to do it. And in fact, if an individual wants to make a charitable donation on death, then they're better making that donation from their main estate, so their non-pension assets, investments, property, that kind of thing, because that's likely to be more tax efficient. So for us, I don't think that passing your pension fund to a charity on death is a good use or isn't efficient. If you know who you want your money to go to, then there are 2 options. The money can go directly as a cash lump sum to an individual, or it can go to a pension. Now, where the simplest option is definitely to make it paid straight out to an individual, but that might mean that the individual receiving it, they may not need it, and it may simply bloat their estate, which ultimately would pay inheritance tax on it. Also, if the pension holder dies after age 75, that money passing to that individual will be subject to 45%, well, income tax up to 45% rate. So the alternative to that is to pay the money from the deceased pension pot to an inherited pension of an individual. Now, for most people, when you say paying money from a pension into another pension, and the whole idea of locking it into a pension, people throw their hands up in horror. But this is a special type of pension. It's an inherited pension, as I say, which would be established on the point of death of the original pension holder, and the special rules that go with it. One of the most important ones is that the recipient of the inherited pension doesn't have to wait till age 55 to get the money out. They can get the money out at any point. So a 30-year-old could receive a pension from you and they could take the money straight out. Secondly, we're under these new flexible pension rules under which you can take out whatever you like, whenever you like. And thirdly, if you died before age 75, all the money coming out of that pension is tax-free. So to my mind, there's no reason not to pay it to a pension fund. There are no downsides, and actually there are several upsides to it. First one being, when that money sits in that inherited pension, it grows free of income tax and capital gains tax. And secondly, if that recipient of the inherited pension were to die, then that money can pass free of inheritance tax elsewhere. So it's a bit, one way I like to think about it, it's like a big ISA, if you like, at the inherited pension, but with additional inheritance tax advantages. And if the original pension holder died after age 75, I think there's even more reason to consider directing the funds to an inherited pension, because if the money is paid out directly to an individual, income tax will be paid on that, as I touched on before. But if it's paid to a pension, there's no tax at that point, and it's only when the individual takes money from the inherited pension that tax is payable. So that second scenario allows the individual recipient to control when they take money out, and therefore when and how much tax they pay. So I think that's very important.
It sounds a win-win situation, really. So what about the spousal bypass trust?
Well, it's fine. The options I outlined there about paying it outright and paying it to a pension are fine where you know who you want the money to go to. Well, what about the situation where you think your spouse is going to be financially secure without your pension fund, but you're just a little bit uncomfortable not leaving your spouse with any cash? And what about also the situation where you might want to pass the money to children, but say little Susie, you could trust her with the cash, she'll be sensible with it, but perhaps little Johnny will just go and blow it on a year of partying. Well, that's where a spousal bypass trust, or to give it a simpler term, a discretionary trust, can really help, because what it does is it gives control and flexibility as well as some potential inheritance tax benefits. So on the pension holder's death, the money passes to this spousal bypass trust. And the money in that trust then isn't in anyone's estate for inheritance tax purposes. There's a list then of beneficiaries or potential beneficiaries who could receive the money from the trust, and that will include spouse typically, children, grandchildren, a wide range of beneficiaries. That money in the trust is not in their estate for inheritance tax, yet they can access that money at any time, so it's very flexible. Furthermore, the trust will have trustees who control that money, and those trustees will be appointed by the deceased, prior to him dying of course, and they'll typically include the spouse so that the spouse can have some control over that money. So it's a very flexible and efficient, inheritance tax efficient way to arrange matters. And the discretionary trust also comes in where we touched on the children situation, and the money may be in the discretionary trust, and the trustees may have instructions to pass money out to little Susie, who they trust, and give her share straight away. But perhaps they've got different instructions for little Johnny, and there might be just to dole out some money over time to see how he gets on with it, and just to make sure he doesn't blow it all at one time. So discretionary trust, spousal bypass trust, can be a really useful tool where the pension holder doesn't know with any certainty who he wants the money to go to, or he or she wants the money to go to. It can allow them to some flexibility, some control, and it can minimise inheritance tax.
Right. But what about any tax on any of the pension monies that are going into the trust?
Yeah. Well, there's two different elements to this. The first is that if the original pension holder died before age 75, the money can pass into that discretionary trust tax-free. So that's a good situation. If, however, the individual died after age 75, there's a 45% tax hit on the money going into the trust. So what that means is that if you have a spousal bypass discretionary trust set up and your pension is being directed to that trust, then as you move towards age 75 and beyond, you need to give some serious thought to whether that spousal bypass trust is still relevant. Is that 45% cost something you're willing to pay for that control and flexibility, or actually has your circumstances changed and directing it directly to an individual or to a pension, is that better? Is that more attractive now?
Right. So basically, individuals need to make absolutely sure that they deal with their pension death benefits.
Correct. And there's probably four things to think about there in closing. One is that we're not talking here about final salary style related pensions. We're talking about pension funds where the individual has an invested pot and they have some control over that. So first of all, check what kind of pension you have. Secondly, where it is a defined contribution pension, a pension pot, not all of these arrangements will give you all of the death benefit options that I outlined, to a pension, to a trust, etc. They may just pay it out directly to an individual. So check what terms you've got with your pension and see if they're appropriate for your needs. Thirdly, the method of indicating to the pension trustees who control your pension fund ultimately, the method of indicating what you want to happen on your death is by a nomination form or letter to the trustees. And it's important to note that that nomination isn't binding on the trustees, it's just what you would like to happen, although in most cases they will follow it. So it's important that you submit a nomination and also you back it up with a letter of wishes, which really outlines in your own words what you want the trustees to think about and consider, your thought process in terms of where the money goes. So complete a death benefit nomination and a letter of wishes. And finally, keep that nomination and letter of wishes under review. Your circumstances will change over time, pension rules, tax rules will change over time, and just make sure that what you've put in place is what you want at that time.
Excellent. Thank you, Richard. That was fascinating. Thanks very much.
Thanks very much.